Your survival on any trade comes down to one number that most traders never think about. It's the trade size, the box you fill in by fill and call your 1%. I blew my first account down to $20 in 3 months, sure that the fix was better entries. It wasn't. What it actually was, I did not see until it had nearly taken the account. So here's the 90-second routine that lets the market set your trade size so that no single trade blows up your account again. You're supposed to risk 1%, but turning that into a real trade size is the exact moment it turns into a guess. Bruce Kovner turned $3,000 on a credit card into one of the biggest currency fortunes alive. The size, he said, is set by the stop loss, and never the stop loss by the size. He settles where he's wrong before the entry, and that's the only way he can't sleep. So sit with where that leaves the entry you keep blaming. You do the exact reverse. You pick the same trade size you always use, then hunt for a stop loss that fits it. So flip the order and the trap falls apart. Before you even think about the size, you decide one thing only. That is, the most this trade is allowed to cost you. Call it 1% of what's in your account today. And hold that dollar figure fixed. The same on your calmest trade and on your most exciting one. And that single move does more than it looks. When you use the same trade size into every market, the trade size stays put, but the risk does not. Take the size you would use on a currency crawling 60 pips a day and drop it on gold reaping 300. Without touching a single setting, your 1% just became 5%. Same trade size, 5 times the loss. That's the floating 1%. The number you swear is fixed, drifting with every market speed. And risking 5% while you tell yourself it's 1% is not trading. It's gambling with extra steps. So you've made the loss a fixed decision, and that feels like the whole answer. But it isn't, because a fixed dollar loss still needs a stop loss. And the second you go to place that stop loss, you are right back to guessing a number out of thin air. So where is that number actually supposed to come from? Everything in you says a tight stop loss is the safe, disciplined choice. It's the opposite. The tighter you set that stop loss, the more it tends to cost you. And the trader who gives a trade a wider stop loss often walks away losing less. To see why a tighter stop loss backfires, forget the charts for a second and think about the last time a car alarm went off near you. Somebody set it as sensitive as it would go, because sensitive feels safe. And now a lorry rumbles past, a cat brushes the bumper, and the thing screams like the car is being torn apart. And you can picture the neighbor 3 doors down, not even lifting his head off the pillow. That's the 4th time tonight. A bus went past and it lost its mind. I'm not looking. Nobody on this whole street is looking anymore. Honestly, just take the car. And that's the trap. The alarm was never broken. It was set to trigger on completely normal street noise. So it cried wolf until it trained an entire street to ignore the one sound meant to protect the car. Most traders honestly can't tell whether their own stop loss sits inside that everyday noise or safely beyond it. And the free 3-minute diagnostic quiz in the description below shows whether your stop loss is unsizing or what's draining your gains. Now, picture your stop loss sitting a few pips off your entry on a market that swings 100 pips before lunch. It trips on a completely normal move and hands you a loss you never needed to take. And after enough of those, you do the exact thing that whole street did. You stop trusting your own stop loss and you start pulling it off your trades entirely. So here's the fix, and it takes about 10 seconds. Instead of guessing at stop loss, you read the one number the market is already handing you. On your daily chart, pull up the 10-day ATR, the average true range. In plain English, that's the market's normal daily move. How far this market travels on an ordinary day. For a currency, you take 0.8 of that number and place your stop loss that far beyond the level that would prove your trade wrong. and never closer than about 50 pips, because anything tighter is inside the noise. Faster markets like gold or an index need more room. So there you go 1 to 3 times that daily range, set from your own backtesting. That's the speed limit trade. The market posts the speed and you match it. I stopped using a stop loss distance a long time ago, but I read the one the market was already showing me. So the market hands you the stop loss. Your stop loss is capped at 1%. And on paper, you look done. But those two numbers only ever protect you if the very last move goes right. And that last move has blown up more accounts than any bad entry I've ever seen, including one night, very nearly my own. Do it by feel, and everything you just built to keep yourself safe becomes the exact thing that ends you. There is one box on your trade order ticket that decides everything, and most traders fill it in last. By feel, half asleep. Get it wrong by a single decimal, and a trade you are sure was safe can cost you 10 times what you planned. I learned that on a night I should have been asleep. It was past midnight. I had told myself, just one more trade, and I typed the trade size straight into MetaTrader from memory, the way I always did, 0.1. I clicked, closed the laptop, and went to bed. The next morning, the profit on that trade was huge, way too huge. I just sat there staring at the screen thinking, that can't be right. I never risk that much. Then it landed. I had not typed 0.01. I had typed 0.1. 10 times the size, 10 times the risk on a trade I had sized by feel at 1 in the morning. It went my way that time, so it wore the costume of a win. But sitting there, I understood something cold. The number that decides whether I survive had been getting typed by the most tired, careless version of me night after night. And one decimal the other way is how accounts die overnight. So here's the last line of the routine, and it's one short calculation. You take the loss you fix at the start and you divide it by the stop distance the market just gave you. The answer is your trade size. Worked out, never guessed. Let me put real numbers on it. Say your account is $5,000. So 1%, your fixed dollar loss is $50. You pull the 10-day ATR on your currency market, for example, and it reads 125 pips. So 0.8 of that puts your stop loss at 100 pips beyond the level. Now the calculation. $50 of risk divided by 100 pip stop loss is 50 cents a pip. And since the smallest trade size, 1 microlot, is worth 10 cents a pip, 50 cents means 5 microlots. You type 0.05 and you stop touching it. Your take profit is simply twice your risk, $100, set in the same breath as the entry. Now, look at what just happened. You never chose that trade size. The market speed chose it for you. On a calm pair, your trade size comes out bigger. On a violent one, it comes out tiny. And the dollar you risk never moves off 50. That's the volatility governor. Your trade size floats so that your dollar loss can't. And the same calculation refuses your worst trades for you. If a market is so wild that even the smallest trade size risks more than your $50, you don't shrink the stop loss to force the trade in. You skip that market until the account is bigger. So 1% a trade or less. That's the line. And every trader who's still standing years from now stayed on the right side of it. Run those 3 lines once and something changes that you'll feel long before you can see it. You stop bracing every time you click. A losing trade becomes a $50 fact instead of a threat to everything you've built. And you close the laptop like someone who already knows the worst case and made his peace with it. You don't have to summon that as discipline because it's just a number that you set while you are calm. The very first trade you size this way, work the loss out before you even glance at the size box and let that one calculation make the call it was always meant to make. This routine can't tell you the trade was worth taking. It sizes a rubbish trade setup as cleanly as a brilliant one. And a perfectly sized bad trade still drains the account. So watch this next, and I'll show you the 3 questions that will tell you in under a minute whether a chart is worth trading. See you in that video.